This third video on the trade life cycle takes a look at the very first steps of trade life cycle. What are the activities of the front office in the dealing room of an investment bank or a hedge fund? As we already know, these participants trade extensively in different assets like equities, commodities, bonds, and foreign exchange in different markets. These assets are traded in different combinations so as to create a large portfolio across zones like APAC, the Asia Pacific region comprising many countries of Southeast Asia and the Pacific region. They could also be trading in the EMEA markets, that's the Europe, Middle East, African markets, covering a large commodity base of some of these countries, especially those from Africa. The hedge funds also operate in the LATAM countries, that's the Latin American countries, largely to trade in commodities as well as metal commodities, that's the hard commodities. So hedge funds have different exposures in different assets in different currencies across different zones. The dealing room is structured around two desks, the client desk, which looks at sales trading, and the interbank trading that looks at trading directly into the markets. Can a dealer directly start trading, waking up in the morning and go and start trading? The answer is obviously a big fat no. This is because the dealing room has to have some pre-trade steps. These pre-trade steps help the dealer to take care before starting the trading position. These include three of them: counterparty limits, the trading position, and the pricing for the contracts that are going to be entered by the bank. This reduces the risk exposure of the bank to credit risk and market risk. The very first step of the trade life cycle is trade execution. Orders are filled into the systems of the stock exchange or the OTC markets, and when the orders are matched, we get what is called as a trade. As we already know, exchange is a centralized trading, and these include markets like NYSE, NASDAQ, etc., whereas OTC markets are markets which are over-the-counter markets, that is decentralized trading, where foreign exchange and commodities are traded. So as the orders get filled into the systems, the prices are matched, the trades get executed. The second step is the trade capture. The trade capture takes into consideration what are the trade details. The main sources of capturing the trade data include static data and reference data. Static data refers to data that does not change frequently. Okay, it doesn't change often. It can change, but it doesn't change often, like bank details of the counterparty, custodian details of the counterparty, and so on. Reference data refers to data that often changes. For example, market data, market prices, the trading venues where it is traded, and so on and so forth. So a combination of static data and reference data are used to capture the trade details of the trade so that all the data is captured at one point. This then results into the trade details being passed on to the to the middle office for trade validation. The main trade details that are captured include quantity of the stock that is purchased, the counterparty to the trade, what is the price at which the trade was executed, the settlement date, amongst others. These are data points that cannot change at all during the course of the trade life cycle. Thank you so much for watching, waiting for your comments, and looking forward to hearing more from you.